So people are worried about the future, even though the past doesn't really, what's been happening in the market's been very quiet. So that there's a real dislocation there. So much about investing and trading is about flows, right? And there's truth in price and truth in price action. People are hedging the election event. So odds are, like anytime you go into a big data print or the FOMC or another event, odds are that traders are hedging the event because they're hedging their tail, but odds are the event is going to prove to be less than people's expectations, right?
Welcome to the OPEX Effect, a joint podcast from Excess Returns and Spot Gamma, where we take a deep dive into the world of options and the flows they generate in the markets. Join Brent Kochuba and Jack Forehand every month on Options Expiration Week as they look at the major developments in the options world and how they impact all of our portfolios.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital.
So I feel like I always say this at the beginning, but it's a really interesting time, I think, in the market right now. And you'll be able to maybe explain a little bit behind the scenes about what's going on. But I feel like, there's been so much going on in the world recently. There's been like geopolitical stuff. We got the election going. And like on one hand, you're like, something should be going on here with the market. Like nothing's happening. And on the other hand, I always say to myself, well, the market always climbs the wall of worry. So maybe that's what we're just doing again. But I'm interested to like dig in behind the scenes here with you and talk a little bit about what we're seeing in the options market, because I see that dynamic at a high level and I really don't know what's going on behind the scenes.
Yeah, I know what you mean. And sometimes I think, is it just that, we're also connected now that everything seems crazier, or is this legitimately just crazy? And, you look at the election coming up and that's all wild. And then, all these hurricanes and, and all this other stuff. It's interesting times. But to your point, we are climbing somewhere in there, a wall of worry, and market's up 2.5% over the last 5 days alone. So, equities are marching along, irrespective of what's going on around us.
Yeah, it's kind of an aside, but to your point, like we have so much, part of this might just be we have so much information these days, like, and it's thrown at us so quickly that maybe like what we think is always been going on, like forever, it's just jammed in our face all the time. Like there was this, Cliff Asness wrote this paper about like the efficient market hypothesis and stuff, and we've talked to Wes Gray about it on our podcast, but like there's an argument that basically all this information has made all of us more crazy. In terms of how we act in the market and how we behave. Like we're just getting hit with all this stuff, and it's not doing good things for us.
Yeah, and it's funny is I've equated that to trading, right? You see the explosiveness of zero DT options trading and short dated options trading, and that it's half of the options volume now. And so there's this frenetic day trading happening for just to put it in a bucket term, and a lot of that is just algorithmic, right? I mean, you definitely have a lot of people sitting there pointing and clicking. But they're trading against algorithmic, HFT type flow. And it's sort of either like you want to try to participate in that, or you should just zoom out a little bit and, think slow, think deeper, and go counter trend to being more connected and getting information faster. Seems in some ways to be maybe the more successful way to just live life and maybe invest nowadays.
Yeah, I would think you don't want to trade if Ken Griffin is the other side of your trade, probably, right? I mean, that probably doesn't end well for you.
Or Cliff Asness, or I mean, those guys are billionaires for a reason.
Exactly.
And
But anyway, so we're gonna dig into all that today. We're gonna talk about the election, which is interesting to me because I think maybe, and we'll find out in your slides, but I think maybe the reaction to the election coming into the election is a little bit different this time than it's been some of the previous times. But you'll explain that more as we get in there. But we always start out talking about just how options impact the market in general. And you started out with a slide that we used last time as well. And it's really interesting to me because it just shows how much the volume of options use has increased, especially post-pandemic.
Yeah, if you're curious about how this options flow impacts markets, like you said, we last episode did I won't call it a deep dive, but we did kind of a 101 class on that. And we started with this presentation of saying, or slide saying, why do options markets matter so much to the underlying? And it's because the options volumes continue to grow. So you can see here in 2020, those volumes exploded, obviously, with the birth of electronic trading. You could trade on your phone, basically from Robinhood and commission free and all that. And now zero DTs have exploded. So daily expirations, that's half of options volume essentially now. And the exchanges are talking about adding zero DTE single stock. So right now, single stocks expire every Friday, but they're thinking about daily expirations, and why not? Because the exchanges make a lot of money doing that. So as these options volumes grow, they have to be hedged using the underlying stock. And that suggests to us, or implies to us, that more of that stock volume is going to be controlled by options hedging.
It's interesting to me. We just had Jem Kersan on the podcast like a couple of weeks ago, and I was asking him about this because for someone outside the space like me, there's this tendency to say, well, there's this huge use of options. It's a massive risk to the market. And his answer to that I thought was a good one, and you can tell me whether you agree, but he was like, it's not the increased use of options. It depends on how they're being used. And so at certain times, they can increase volatility during certain events, but at certain times, they also can be really dampening of volatility. So it's not like you look at just increased options on its own as some sort of risk to the market. It's about like, how are they being used at any given time?
Right. And it's, one of the key elements of investing or speculation or anything, whether you're looking at, beating babies or anything else, is imbalance, right? If there's a lot more, buying demand and aggressive buyers, that's going to drive the price up. And in a similar way, if you have only call buying in the options market, that creates GameStop in 2021, for example. Or in March of 2020, there was unbelievable amounts of put buying, and that really exacerbated things to the downside, right? So I totally agree with his point there. Oftentimes we have balanced volumes that suppress volatility, and then other times you see it go the other way where, panic either to the upside or downside exacerbates that volatility.
And that's what we talk about a lot as we get into your next slide is there is this options expiration cycle, and how people are positioned or how people are using options as we move into these expirations is really important.
Yeah, the key thing here is we have OPEX this week on Friday. We actually have VIX expiration tomorrow. So positions start shifting starting tomorrow, Wednesday, the 16th into Friday, the 18th. And the idea here is that every 30 days is a big kind of material options expiration. That's where the bigger funds will keep their positions. And so what happens is the volume or open interest associated with that third Friday expiration builds up into the expiration itself. The associated options hedging positions build up in kind with that. And then all of a sudden, bam, all those expire, those positions all go away. And then that frees up the options, the underlying movement, right? Because that hedging flow that was so dominant into options expiration suddenly shifts. And we've seen that create a lot of turning points in the market. We have a bunch of those noted here. We flagged some of the most prolific bottoms in the last 5+ years on this chart. It does work to the upside as well. In this case, we actually have some data, if I flip forward a couple slides here, that shows us that around options expiration, 68% of the time we actually turn. So what does that mean if we rally into options expiration? 68% of the time we sell off after. So there's a lot of data and stats that actually back this idea that options can cause turning points or shifts in the market.
And going back to your OPEX cycle slide, I mean, we can see some of these. I mean, the pandemic is obviously the most clear example of, we had a bottom on an expiration. We had a top on an expiration, and then we had a bottom on the next expiration.
Yeah, that's exactly right. And then most recently we had bottoms in April and August of 2024 this year, where there was bottoms. And, you see in particular what happens in these situations is there's a lot of put buying. There's a lot of high volatility into the options expiration, right? When we're crashing, there's a lot of momentum. And then when you remove all these puts, the short hedges that dealers need to hedge those put positions, they don't need those short stock positions anymore, right? And so they could buy that stock back, and that can lead to a rally, which crushes volatility, right? The VIX will drop if we start to get a rally, and that fuels even more of a rally. So there's a lot of reflexivity in the nature of these flows. They kind of feed upon themselves.
And what I found as a long-term investor is sometimes I'm like asking myself, something's going on in the market, and I'm asking myself, like, why is this going on? It doesn't make any sense to me. And a lot of times looking at these things is the answer. Like, for instance, I didn't know this at the time, but like when the pandemic was really spreading, when things were getting really bad in Italy, you just kind of saw it continue to expand, and nothing was happening in the market. And it was really weird. Yeah. And I'm like, why is the market not going down? And then we hit that expiration, and like it was all over. Like it all fell apart. So obviously, to some degree, those options flows were holding up the market until that expiration cleared.
Yeah, there was a ton of call positions into February 2020, and I like you remember, videos of people collapsing in the street in China, and we were tracking airplanes around the world, and it was clear this was getting bad, and then as soon as you hit that options expiration, that's the weekend that things fall apart. Like news suddenly mattered, right? And you see that happen all the time in timing entry and exit points, and you also see to the downside, right, where the market's crashing and you're saying to yourself, the world is going to end, right? Oh my gosh. And then all of a sudden you'll see implied volatility will drop. And that's a sign that people are starting to sell their puts. And so, so much about investing and trading is about flows, right? And there's truth in price and truth in price action. So sometimes you're emotional and you're thinking about investing implications, but it doesn't matter what you think. It matters what everyone else is doing, right? And I think outside of maybe like deep value investing where you're buying things for, like under cash flow or whatever, then most of us are actually trading flows. You're trading the reaction of everybody else to news and to events versus fundamentals in a lot of cases.
As you can imagine, the deep value investing has not gone particularly well in recent years. But it's also interesting.
No, yeah, but this to the point of short-term frenetic information, right?
Yeah, and then also like that's one of the things I've learned throughout my career is even taking it a little bit longer term, like flows are what drive markets. I mean, fundamentals, which is what people like me use, they're important in that they drive, hopefully, over the longer term, you expect them to drive flows. If people don't care at all about fundamentals and they don't move, they don't buy and sell based on fundamentals and they don't drive flows, then they're not going to matter that much. But you'd expect over the long term, since you're buying shares of companies, that they would. But that's one of the arguments you've seen a lot recently is that we are in more of a flows-driven market than a fundamental-driven market, compared to history at least.
Yeah, I think that's true. And I guess, you have Mike Green on all the time and passive inflows and inflation and 401ks and the asset gathering of the S&P and all that. And so, there's a rising tide element to all of this, certainly. That's for sure.
And one of the things I've learned just before we get into the current expiration is like shaking your fist at the current market is never a good idea. Like being the person who's like, well, the Fed is distorting the market and I'm just going to rail against the Fed and I'm going to set my investment strategy so that when the Fed finally, sees the light, it's going to work. That stuff never works. I mean, you got to play like the field is in front of you. And if the Fed is going to distort the market for a decade, then you've got to invest based on the fact that the Fed's distorting the market for a decade or whatever else is going on. If options flows are having a huge impact, then you've got to understand that. Like people like me that are fundamental investors have this tendency to be like, oh, this is the way the world should be. And I'm setting up my investment strategy to be in that world. And like, unfortunately, we got to live in the world we're in.
Yeah, that's totally right. And, we had the August, people were yelling at the Nikkei carry trade for crashing the market. And I was laughing the other day because we had the JP Morgan roll, which we're going to talk about, was on the 30th. And Powell had happened to schedule a speech at like 2 p.m, and the market dropped like 40 handles in about 10 minutes. And all the macro guys were being like, Powell just told us the world is ending, and people with big followings, But if you look at that time period, the 15 minutes where the market dropped, we had a 40,000 lot, trade printed, huge trade, JP Morgan call roll right at that low, and then the market bounced. So you can see these like microcosms of people, putting their opinion in on macro or drawing macro conclusions from what was essentially just trade flow. It's always a little amusing when you see those.
Yeah, whenever you see like on CNBC, market falls because, like a lot of times, whatever is after the because is not the actual because. Because as you learn more about markets, you see that a lot.
And now that stuff is just written by algos. It's so funny. You see like CNBC's headlines now are all just algo driven. Market up, and then they have to assign some reason to it, and it gets more humorous as we go along here. Bots writing about what other bots are writing.
We're just going to see more and more of that. Unfortunately, as the AI takes over here, we're going to see more and more bots writing to other bots. But
and there's an AI piece to this presentation. So
good.
We're not too far off.
We'll move forward so we can get there. But the next slide, we're looking at what we always look at, which is you're looking at the current expiration and what you're seeing.
Yes. So the huge positions here, 5,800 to the downside. It's a very big strike in options expiration here. The way that we're looking at this market, we talked about balance. So in this screen here, you see orange, which is the value of call gamma, and blue is the value of put gamma. And so the takeaway here is when these positions are balanced or we're maybe a little bit more call heavy, meaning there's more relative orange bars here or call gamma, the market's pretty stable in there, right? Kind of grind higher, drift higher. But we get into zones where we're predominantly put positions, that's where volatility really tends to pick up. And so we mark those areas as risk off. So in this case, we're trading right now around 5850 in the S&P, almost on the dot. And so if we break below 5,800, we're going to get kind of in a neutral stance, we say, where we'll reduce our long exposure. And then under 5750, we're going to be looking to short this market. And that goes, from obviously today out into really the election period, because that is where put positions really will pick up, is under 5750. And in this market, we're going to be talking about the election. There's a lot of tail hedging on. Most of that tail hedging is down around the 5,500 to even down towards the 5,000 strike. So these are true tail hedges. And they have value right now, but as we're going to talk about when we get into the election, those positions could lose value really very quickly, and that could have a market impact. So we'll be talking about that shortly.
Is this a big expiration?
It is, as we see here, decent size. So this is December. December's a quarterly expiration. September was also that we just had. It was a quarterly expiration. So those were, twice as big probably as this. What you take away from this options expiration is it's very call weighted. So in this case, we have call delta. So that really measures the stock equivalent value. Huge call positions relative to put positions. Not surprising, again, given the market rally here. And so this when we have a call imbalance and expiration, that tends to tie into this statistical idea that, we reverse course after expiration, right? Because the hedges associated with these call positions will unwind, and that could allow us to, give some back, essentially, get some consolidation here.
So there's some downside risk because this is a little more call heavy. There might be a little more potential for downside once the expiration clears.
Yeah, that's definitely what we're looking at, and we're really leaning on 5,700, as a short-term low, kind of into options expiration, into this chart. So we have the 5,750 level, which is this short-term metric, and then that we'll have to zoom out a little bit on that after options expiration as we clear some positions out. I don't think, we would really get down too far under 5,700, given the dynamics that we see here. So, right now that doesn't sound that far, but that's a good 2-3% pullback is really what's kind of in the cards, I think, post expiration. And then we're going to move into the selection period, which we're going to talk about here in a
So
moment.
it'd be fair to say you're not seeing anything extreme here. Like I would assume some of these expirations you see like extreme call imbalances, and those are the ones that maybe are the most risky. That's not what you're seeing here.
Yeah, I mean, this is an extreme call imbalance, meaning that there's so much, the positions and calls are so much larger relative to puts, but the overall size of positions is not, it's not a, it's not a top 10 percentile expiration, right? We're not bigger than September. We're not even bigger than December, which doesn't expire, come for another couple months here. So it's a decent size expiration, and the call weighting tells us that, okay, we're looking for a little bit of a pullback and consolidation next week into the end of November.
Okay, and on this next chart, we're seeing we seem to be moving more and more to the right here. We're seeing lower predicted volatility and lower actual volatility.
Right. So we measure dealer gamma, and then we forecast, okay, given today's dealer gamma position, what happens the next trading day? And what you can see here is the larger gamma gets, the more positive it gets, the tighter forward one-day returns are in the S&P. And you could extrapolate that a little bit farther in time as well. But what you see here is essentially we're in a very positive gamma position. That suggests that we have really low volatility, and we're going to touch on this in a second. But the deal is that after expiration, we should drop in this gamma index, because we're losing a lot of call positions. And that decreases positive gamma in the dealer hedging position associated with those calls. And that should allow for more volatility into the end of the month.
So is the idea on this chart, like we always look at this chart right before options expiration, but if we were to look at this like a few days after options expiration, we would always shift left relative to where we are here?
Yeah. And I think this is one of the things that is most interesting here, because with options expiration, positions are going to expire, right? It's a fact. These contracts expire on a day. We all know the open interest information is public. So the market, I don't think always prices this in, right? So we have this very low options prices right now, particularly if you look at very short dated options. And so if we move past expiration, we know these positions are going away, and that is generally associated with, right, lower call gamma, or lower positive gamma, I should say, is associated with higher volatility. And that's what this is telling you. So we know we're going to lose positions on Friday. So therein we should have higher volatility after OPEX as a result.
I wonder, has anybody ever looked at like the data on that? Like I would assume the week after options expiration should be a more volatile week in general than the week of options expiration. Is that right?
Yeah. And that's what this data here is essentially telling you, that the distribution changes. And the trick here is that, this works for the market going down as well as the market going up, right? So you can have volatility expanding into OPEX and then it collapses, or vice versa. Volatility can contract into options expiration and then it can expand. So it does really work both ways, and there is statistical evidence for that.
So in this next chart, you're looking at some of the price action in recent OPEXs.
Yeah, and the thing I wanted to highlight, we're going to talk about this momentarily, is, Brent, you'll go, okay, guys, well, you really highlighted recent, 5 years of history. But if you look here, you can see there's a huge June quarterly expiration. Clearly, the market reacted to that. In July, VIX expiration, which occurred 3 days before OPEX, same as this month, right? The VIX expiration tomorrow morning leads us into October expiration. The morning of VIX OPEX marked the July high, and that was the market all-time up until recently. Admittedly into August OPEX, hard to mark a clear turning point there. That wasn't a particularly impactful expiration. And then we moved into September OPEX expiration. I'm going to touch on this shortly, but when you look at the JP Morgan collar trade, something that's kind of been beat to death in my space in terms of people talking about it, I think macro investors here will find it interesting, so we're going to touch on that. But you'll see the fingerprints in recent months, days and months, of how the options market really affected price action. And I think that's really going to be true into options expiration here, but more so into the election on the 5th.
So as we move forward here into our projections from last time, this is one that you actually corrected me on when we had talked about how important NVIDIA is. And I said, well, it's important, but it's not that important. And then you proved to me after that it is exceptionally important, especially when you consider what's going on in options.
Yes. And we talked, the whole presentation, it was called the NVIDIA Options Complex. And I recommend that everyone goes back and watches that presentation, or you can Google Spot Gamma NVIDIA Options Complex, and then you'll see that presentation. Because we talked about the flows associated with NVIDIA and how that would drive the entire market. And we saw the evidence of that into September expiration. And in this chart, you see the SMH really leading all other stocks into September options expiration. And so we said, you got to really key off of this. Now, NVIDIA, through the end of September into early October, didn't perform very well. But the last 10 days, as we're going to show you, it's been ripping. And that's really correlated with this market going up. So we were talking before we started here about surprising how strong the market is right now, right? Well, there's a couple of reasons for that, and NVIDIA is one of them. So, watching NVIDIA as a telltale for the market was one of the things we said was critical. And there's some evidence that proved true again here over the last month. And that's related to the leverage associated with NVIDIA. There's over 500 ETFs that incorporate NVIDIA. NVIDIA is the largest options volume stock in the U.S., huge call volumes, huge short-dated options volumes. It is really the driver in a lot of ways of the U.S. market.
Yeah, and it's crazy. This is a total aside from options, but I was just listening to some podcasts recently where they interviewed Jensen, and just thinking about the moat NVIDIA has and how involved they are in everything that's going on in AI, and not just chips, but the software that runs the chips. It's pretty crazy how important NVIDIA is to that entire AI complex.
Yeah, and I listened to that as well, and I didn't put any slides or any touch on those points because I'm not a macro analyst, but he seems to tell you that we're only in the beginning stages, and I think all CEOs want to say, hey, we're positioned for explosive growth here, but there's something that maybe rings a little bit more true about that. In this case, again, I'm not a macro guy, so I can't tell you that, but I can tell you that the amount of flow linked to NVIDIA stock, and then you see call options come in, and it's very easy to lay out how this stock can literally control the entire market. And that sounds hyperbolic maybe a little bit, but you look at charts like this where there are indeed 528 NVIDIA ETFs, huge institutional ownership. And we had basically said that, look, when you have all of these entities, not just huge institutions, but people who want to own NVIDIA stock, that the tradable float of that stock is really a lot smaller, I think, than we all believe. And then you add on to that this options flow, and the options flow dictates that market makers may have to buy underlying shares of stock. Well, they're forced to buy that stock into deteriorating NVIDIA liquidity. And that can mean that there's a lot more underlying volatility, right? Because there's a smaller piece of the pie that people have to buy up. And I think that, this is something that we see, I think, through the market because, it's amazing you can have a $3 trillion company move 4, 5, 6, 7, 8% a day. It's pretty wild, right? The value that is swinging around there. And so, again, you see these fingerprints all the time, and I'm going to show you here how that even is existing today.
Yeah, and that's been the big lesson of doing this podcast for me is you want to try to attribute when NVIDIA is moving in these days, you want to try to say, oh, they announced this or they announced that. And a lot of times that's not what it is. A lot of times this behind the scenes flow stuff is really what's driving that. And it's important, as a long-term investor, to at least understand that. You might not be doing anything with it, but if you attribute it to the wrong thing, that can be bad.
Yeah, that's exactly right. And everything is about, supply and demand, and there's not much supply in NVIDIA, and there's a ton of demand for the stock, and so as the story gets better, and themes get stronger, and Jensen Huang comes out and keeps saying, customers are fighting over our chips, and all these other things, and there's no other competitors, and blah blah blah, then the theme stays pretty strong. And if this stock is going up, I fully wholeheartedly believe that the rest of the market's going to go up because of it. And we all have to bow down to our kind of AI masters, I guess. In that
I think we're going to be doing that eventually anyway, so we might as well get started. So what are you looking at with rates on this next slide?
Yeah, the other thing we touched on was this idea. We were approaching the FOMC. So our last options conversation was before FOMC. We got a 50 bips rate cut. And what was funny is longer term rates actually went up, which was different than I think some of us, me not being a macro guy, expected. And there was a lot of rate volatility around the FOMC. And so we had talked about the idea of, before this rate cut, you couldn't really hedge yourself with bonds, right? You couldn't hedge equity positions with bonds. This is like kind of the 60-40 portfolio. And in 2022 and 2023 and even early 2024, like there was essentially no alternative to stock. And so the argument is now there is an alternative to stock with the rate cuts. However, now suddenly the long-term, 10-year or longer dated bonds, rates have actually gone up. The 10 years back over 4%. And so I think, this is one where I maybe weighted a little bit too into the macro side of things because it seems like we're assuming that whoever gets elected is going to be inflationary.
Which probably is true, by the way, on both sides.
Yeah.
I think unfortunately they're both looking to spend some money.
By the way, I'd like to sneak this now. As we wade into some political conversation here, anyone that has any issues with any of the statements today, you can email Jack
Exactly.
We'll
flash my email address up on the screen here. love getting more hate mail than I already do.
Yeah, so I'll make some real agitating statements and comments here just to get.
Yeah, I think you should definitely. I'll enjoy it.
And then the last thing, we talked about this key level 5750 at September options expiration. We said that was the level you had to watch out of OPEX, and I don't state this to. I admitted we took an L on this TINA, the rate thing, and that was interesting. But this one, 5750 was the JP Morgan collar strike. They were short that call. And I have another side on this momentarily, but we had some volatility out of the FOMC, and then we moved right to that 5750, and we stayed there until September 30th. And then at September 30th, that position expired, and then we really started to move. Volatility really started to come in, and we released that level. And so, you talk about longer term investors, and that's quarter end and stuff. And these are the levels that I think you can use to help you to allocate, right? When you're looking to buy or looking to sell, you can watch these options dates to take advantage of the relative movements and kind of allocate around those, around the timing of those big trades coming in.
Just for people who aren't familiar with the JP Morgan thing, it's basically, you could explain it better than me, but it's a huge fund, right, that has a massive hedging trade that they rebalance at the end of every quarter. Is that like a high level what it is?
Yeah, so they own a bunch of stock, right? They have a formula they use to buy mostly large cap stocks, and it's a $30 billion fund, so it's very large. And every quarter they roll a collar trade. So a collar trade is they sell a call, 3 to 5% of the money call that expires for the next quarter, and then they use that to buy a put spread. So generally what that looks like right now is at the end of September, they sold a 6,000 strike call, 6,055 specifically, and they use those funds to buy a put spread. And the idea is that if there's a huge tail event, right, the market really crashes, they have this hedge. If you look back at the history of that trade, that put doesn't go in the money ever. So, it's unclear that this is actually benefiting anybody. But in theory, if we had kind of a doomsday event, then I guess it might, because they don't ever close the position early, right? They leave it on to expiration. So that kind of limits the value of the position, right? Because if we crash, the put that they own could make money, but they don't hedge it or do anything to monetize that position at all, right? And so what happens into the end of the quarter, it becomes a hedging event, to this talk on flows, where there's a dealer who's short these puts, right? So for testing that downside put strike, the dealer's short the put. They don't want that put to go in the money. And so if you look back in 2022, that put strike was tested a few times, and we literally closed like five handles above it. So the put expires worthless. The dealer doesn't have any pain, and the JP Morgan fund didn't make a in their position. So it's kind of funny to watch. But in this case, we pinned that new strike is 6,050. And so, that is a big year-end target for a lot of people, right? That 6,000, 6,055 level. You see a lot of banks targeting that for a year-end move.
Just briefly, I'm just curious, is it less important now? I mean, I remember hearing a lot more about it because people know about it, or is it less important to the market than it used to be?
No, we'd run through the collar strike a bunch of times. So what matters is the proximity to the strike as we get into expiration, right? And so, it absolutely controlled the market over the last, at the end of September. And you can see that in the pinning. You can see that in the way the market moved. I mentioned that, that the macro guys freaking out about the Powell comments on September 30th. Well, that was the day the trade rolled, right? So we had this big intraday volatility that people go, oh, it's macro, and it's not. It's this big fund getting rolled. So, the fingerprints of that trade are seen when we're near that strike. And there's some path dependency to how we get there. But the trade definitely matters, when we're near it and kind of how we approach it.
So as we move into our what is move section here, we are on an NVIDIA because, again, it's the most important thing out there.
Yeah, we're on NVIDIA here, and this is the JP Morgan trade. So you can see 5750 right here. And you can see this green and red candle is when the day after the position expires. So all of a sudden we moved from FOMC, we locked into that 5750 range for about a week to 10 days. And then as soon as that position expired, we kind of wrenched our way out from that position. We're talking about positive gamma, right? That 5750 trade, when the dealers are long that call, 40,000 contracts to that call, it's a massive amount of positive gamma, which means that market makers are buying dips and selling rips around that strike, right? And it pins us there. So when that trade goes away, the market starts to shift and move around. But we were looking at, hey, it seems strange that the market would have this rally right now, given the geopolitical backdrop. We had, some flare-ups in the Middle East, and that hopefully is calming down now. And then we have the election coming up, and then the rate volatility. And essentially what you have here is you can mark the day that NVIDIA started to really rally, which is October 4th, roughly. And the stock is up 10 to 12% roughly over these last 5 days. And at some point, the market just gets shoved up by that. And you can see that here. And if you look back anecdotally, you can see other points wherein this has occurred, right, over the last couple of months, where NVIDIA rallies and the rest of the market just ultimately gets dragged up by this, right? It's like you're holding yourself onto a car. If the car's going forward, well, you're going to get dragged down the street. And that's kind of the way that this shapes up. The other thing that's really fascinating about this dynamic is you look at the VIX, right? And the VIX is at 20 roughly, 1997 today ahead of VIX expiration. Realized volatility at a 1 month basis. So how much the S&P has been moving is at or near lows. We really don't get much lower than where we're at right now, which is roughly 9% realized volatility. So on a daily basis now, despite the risks that we all feel like are in the market, the S&P is really not doing anything, right? We're just grinding higher every single day. And yes, we're up 2% over the last 5 days, but that's occurring because we're just doing like 40 bips a day, right? So there's not a lot of market movement here. And what matters for this reason is because we talked about options expirations, suppressing volatility, right? So we have realized volatility, which is, so the market's not moving at all. We have these big call positions that are built up into options expiration and VIX expiration this week. And this is all timing to say, okay, well, the market is moving about as little as it possibly can. We're going to remove all these options positions that are suppressing that volatility. And then we have this kind of election event looming in a couple of weeks. So this is a great recipe for a short-term correction in the market because there's essentially nowhere else for the market to go, in my view, right? We're basically pushed down on the floor in terms of how much the market is moving, and it's, there's nowhere else to go. We're on the floor already. And so when you move these positions, we should have volatility expand, and I think, again, that leads to a correction in the market.
Is that gap between the VIX and realized, I would assume that's pretty wide relative if you, carried it out throughout history?
Yeah, that was a psychic question that you asked there, Jack. This is this is variance premium. So Yuan Sinclair is a great options mind, and he posts a chart like this in one of his books. It basically says if you compare the VIX to 1 month realized volatility, so that's the green line on this chart. So the VIX right now is at 20, realized volatility is at 10, so there's a 10-point spread essentially there. And what you can see in this blue line is that's pushing up near the upper bound of the spread here. What does that mean? That means that the market is pricing in a lot more volatility than we've been getting. That's essentially what that's telling you, right? So people are worried about the future, even though the past doesn't really, what's been happening in the market, it's been very quiet. So that there's a real dislocation there. Generally, you only will get spreads this big during times where the market has crashed, and then you'll see a lot of fear come to the market. So, an August 5th scenario, for example, where all of a sudden put demand or demand for hedges, makes the VIX move up excessively and people really freak out, right? That's where you get that kind of bigger spread. In this case, people are hedging the election. So that is keeping the VIX and implied volatility bid up because we're obviously hedging that event. But the market is moving not at all. So usually what happens is this premium will collapse. And what you can see here is this blue line, which is around, call it 10, is going to move down to the long-term average, which is a 3-point spread. You can see that here. And usually it'll overshoot a little bit. So we'll head to where maybe the VIX and realized volatility get a little bit closer. When that happens, the market generally rips, right? So when the market rips, the VIX gets sold, the VIX comes down, the VIX doesn't get sold, but options implied vol gets sold, and the VIX drops, right? And that pushes the stock market higher. And I'll explain how that works in a minute.
So is it, when these separate like this, I guess it could be, does it tell us anything in terms of how it gets resolved? It could get resolved in two different ways. And it could get resolved by realized going up, or it could get resolved by the VIX coming down. I guess both of them are possibilities.
Yeah, excellent point there, Jack. And so in the short term here, it's very hard for the equity market to sustain realized vol of, 16 to 20. We were doing it in 2022 a little bit where there was so much, large daily swings. But unless we actually get a risk off event here, like, more missiles start flying or rates materially jump or, God forbid some event happens in the election or the election is just a mess and no one knows what's going on. Like we need a trigger for realized vol to actually sustain moving 1% daily moves, right? And 16%, you can use as a benchmark, 16% annualized vol is 1% daily moves. So if the VIX is 16, that tells us that the market's pricing in 1% daily moves. Or if, 1 month realized vol is 16%, that tells us we're getting 1% daily moves. So right now we're getting 50 bips, 60 bips daily moves. Not all that much. So to your point, either the VIX can hold 20 and we can have realized vol move up so that we start getting 1% moves. And I think in the short term, we could get bigger daily moves because the options expiration is going to drive volatility, right? We'll see some pickup. But what we have here is event volatility. People are hedging the election event. So odds are, like anytime you go into a big data print or the FOMC or another event, odds are that traders are hedging the event because they're hedging their tail. But odds are the event is going to prove to be less than people's expectations, right? People are worried that, we're one way or the other going to end democracy at this election, for example. Odds are the democratic process will work. Someone will be elected. That person will take power in January and we'll all move on with our lives, right? So, as a betting person, you probably want to bet on that type of outcome. And so in that case, we may have some short-term volatility here. And then around the election, we're going to get some volatility because we'll have a result and the markets are going to react to that. But when you start projecting into, mid to late November, markets are probably going to be pretty calm. They're going to start to calm down, and that VIX is really going to drop, right? We're likely to see kind of like a 15 VIX and 10% realized vol into the end of the year. Yeah, hopefully that makes sense.
It does, yeah. Your next slide gets at this idea of the election event premium. And this is one of the big lessons for me, because if you look at the two previous elections, you had the first one where Trump won, and there was all this concern about, like, Trump was obviously the word unconventional is probably the word to use, very different than anybody else. And there was all this concern about what he would mean for the country. And so there was tons of hedging going to that one. And then the next one, everybody was worried about the disputed election, that, he's not going to leave the White House. So there was tons of hedging there too. So I'm interested to think about, like, this election relative to those in the context of what you're seeing in the options market.
Yeah, and the implied volatility around this election was initially higher, meaning that it seemed like there was a little more risk priced in the market, and now it's flattened out a little bit. So I don't, it doesn't seem to me to be the same risk that we saw priced into the market. I'm going to show you why that is. But what is most interesting to me on this is that, uh, to your point, when Trump was elected in 2020, I remember at 2 a.m. watching the futures market and thinking, this is the craziest thing I've ever seen. Like the market freaked out at first and all of a sudden it just rallied back. And it was like, at the end of the day, if you just slept through the election and woke up and you only cared about markets, it was like, okay, today's, whatever day it is, Wednesday, and couldn't go about my investing day as opposed to getting ready for the end of the world. In this case, what's so funny is implied volatility. So this is S&P term structure. So each one of these dots is the at-the-money implied volatility for all expirations. And you can see for post-election expirations were elevated. So we're about 15, 16% implied vol, which is pricing in 1% daily moves. But before the election, the implied volatility is incredibly low. That cone there is 90-day values. And so we're at the bottom of that cone, which essentially tells you that markets are pricing in no market movement from now until the election. I think that is incorrect because of options expiration. We're going to start moving. The other thing about this is that when people are projecting very low volatility, right? We saw the 0 DTE straddle the other day priced at 40 bips, meaning that the market was pricing in just 40 bips of movement on the day. It's very easy to move more than 40 bips, right? It's up or down. That's not a lot of volatility at all. So when we price volatility at the floor, which is what we're doing now, if you get anything more than the lowest expectations, right? We have very low expectations now. So if we get just a little bit of volatility, like a 50 or 60 bit market movement, then suddenly everyone has to reprice. And that itself causes volatility. Does that make sense? Like you're anticipating a 40 basis point move, which is essentially nothing, and you get a 60 basis point move. Well, that's pain for you, right? You got to cover your trade. And that short vol cover causes volatility in and of itself. Does that make sense?
To make sense.
Yeah. So it's a volatility cycle. We're at the low of implied volatility for short-term options. We're at the low of volatility in terms of realized volatility, how much the market's been moving. We've had a big rally, and now we're going to trigger some position shifts starting with options expiration Friday and VIX expiration tomorrow. And so, whatever the data points are before the election, there's some JOLTS numbers in here, GDP and blah, blah. Nobody cares, right? Just nobody cares. That's what this is telling you. Everyone's just kind of focused on the election. But we're so close to the election now that if we get a little bit of volatility, that volatility pricing is going to get sticky because the election is just 2 weeks away or 3 weeks away. So that's the catalyst here to have a pretty healthy correction, I think, over the next 1 to 2 weeks.
If we had looked at the same chart, like for the previous two elections, I'd assume the spike would be bigger in the chart, right? People were hedging more for the election than they are now?
Oh, yeah, a little bit bigger. I think this has come down over the past week or two. I think that the implied vol will go up again as we get towards the election itself. So, this is very dynamic. And I think when we get towards like November 1st, we'll see vol will pick up because, the election is really front and center.
Yeah, and I think that's what we've seen with some of the other ones too, right? It picked up before, and then everybody was worried, like once the election cleared, we were going to have this major downside event. And that's where these flows kicked in, and we actually went up in both cases.
Yeah, and there's a lot of hedges. There's a lot of tail hedges on right now. Again, I mentioned before, if you look down in the 5,000 area of the S&P, if you look at VIX calls, like people have hedged this event, and the hedges are sitting there. And so, they don't necessarily need to do anything more. Again, I think some people will just hedge, the week before the election event itself, because the argument is why carry, the hedging why carry that hedge over the next 2 weeks? That probably hasn't profited a lot of people very well, because there's drag, right? There's carry costs with that. So we'll see what happens. I mean, we're always one headline away from, who knows what happens in this type of environment, unfortunately. So we'll likely see implied vol lift up for those post-election periods as we get closer to November 5th.
So what are we seeing on this next slide with the election twist?
Yeah, well, one of our core views was that we didn't think there would be a strong equity market rally into the election because implied volatility was likely to remain elevated into the election itself. And we also had the issue of, this was we were thinking about 2 weeks ago. The Middle East situation was not going in the right direction, and then rate fall, as I mentioned before. And so the idea is that there's this concept of Vanna flow, and Vanna is essentially telling us, like, look, when VIX or the volatility index goes up or implied vol goes up, that pushes the market down, and vice versa. When VIX or implied volatility drops, it pushes the market up, and that's related to hedging flows. I'm going to tell you why that is in a second. And so the idea is, without that Vanna flow, right, without implied vol dropping, we didn't have this mechanism to shove the market up. What's interesting here is that in the last really 2 weeks, not even 10 days, we've seen people suddenly start to get worried about the right tail of the market and starting to sell off the left tail. So what you see here is this is for November. This is what we call November skew. So this is from 10-1 in gray, and and today is in blue or teal. And what you see is put implied vol. So the implied volatility for downside strikes has dropped. So that tells us that the downside hedging pressure is eased, or demand has declined, whereas the upside, and this is kind of the 20 delta calls, 10 delta calls, is starting to lift. So as the market has kind of rallied here, maybe, because of the market rallying or people positioning, they're sort of linked. We're seeing the put side get sold and the call side get bought. So the relative level of implied vol remains high, but we were literally just kind of rotating from what's called a put skew to more of a call skew, right? The calls are starting to get a higher implied vol than the puts, which is telling us that people are, for whatever reason, starting to position for a post-election rally. I am not here to say, I have a few theories as to why that is, to the point on sending your hate mail to Jack. I was laughing about this a little bit because, you don't know what the reason is. And I don't necessarily think it's that Trump is starting to pull ahead in the polls. I actually think this is more of an NVIDIA thing, but I put in this chart. This shows this is from Polymarket, and Trump's odds of winning in Polymarket and some of the other betting markets has really increased recently. So green is Trump, and purple is the spider close. And, okay, it's only the last 10 days, but you can see the skew really moved at the same time. Correlation is not causation. I don't put this on as any type of pro-Trump or pro-Kamala statement. Just showing that it was just kind of funny. There's this little correlation, and I think the reason I really wanted to show this is because I actually don't think it matters in the short term. So I'm talking to the end of this year, who wins the election. I think as long as it's a clean election, we know who the winner is, we can all move on with our lives. In the short term, there are these flows that are going to move the market higher. And so I don't know if the market is starting to like Trump policies or say, okay, we know what Trump is, and so let's all get long equities, because I think everybody assumes he's going to do what he can to move the equity market up. I really don't know. But if this slide upsets you, Jack at OPEX.
Yeah, exactly. But I also wonder if maybe people are on to this election thing. We've had everybody worried in these last two elections, and then we've had the rally after. So, I wonder if people positioning themselves more in calls is a function of, they're trying to learn from these previous elections and been all right, everybody's always going to be worried in the election, and we always get these rallies. And maybe that makes it less likely we actually get the rally. But it's just interesting to me, maybe that plays into it.
Yeah, and we're talking about inflation before, and I think that one of the macro feelings I have is that both candidates and kind of all politicians are going to support inflationary policies, and so if that's the outcome of this whole thing, is that we're going to get more inflation, then you got Ellen stocks, I guess. I don't know.
Yeah, and I was mentioning this to you before we recorded, and who am I to know anything about this? But I personally feel like the market probably wants gridlock. They probably don't want either party to have complete control to do whatever they want. Gridlock is a pretty good status quo outcome for the market, probably at this point.
Yeah, and I think that's true, right? At the end of the day, as investors, we want a relative level of certainty, right? And as long as we know what the deal is, even if we don't necessarily like the policies, well, we can invest around those policies, right? And yes, you want good uncertainty, like how many chips will NVIDIA sell? That's some uncertainty. But at the end of the day, give us a stable environment, stable policies, things that we can, count on. And, I think at least in the short term, like I said before, regardless of who wins, we're going to have a couple of months of, who cares, right? There's still another president in office, and policies won't be changing anytime soon, kind of regardless. So as long as we get a clean election, we don't have one of these kind of hanging chad scenarios, then great. And the other thing that's just sad about this world is I was thinking, about assassination risk, right? And it's just such a weird thing that we have to worry about that in this market. And there was a headline that came up that said Trump was asking for F-15s. I sort of like halfway, wave my hand and laugh at that, but that those is crazy things that you have to hedge in this event, right? And that does that drive some hedging demand just because you gotta, these outcomes that just seemed improbable or have a small probability now? I mean, it's really it's a little bit of a crazy world. So if we can get a clean election, we get a new person in office, either way, then the market can say great and move on with its day. So
yeah, and let's hope for all our sakes that's exactly what we get. Because this is obviously a lot bigger than whatever's going on in the markets, and hopefully whatever it is, we get a clean election and everyone accepts it and we move on.
Yeah, and again, Jack is open for email. So if you assume as a betting man, I'm just going to assume that the that the outcome is we get an election. We know who the president is within a reasonable amount of time, and the market resumes its rally. Now, what's funny is 10 days ago, everyone was circling 6,000 as the year-end rally, right? And that seemed fairly far away. It was 5-ish, 6-7%. Now suddenly we're trading 58.50, and 6,000 is not so far away in the S&P. And what catches my eye there is there's this humongous call strike there. There's a ton of call positions. The JP Morgan caller position is also at 6,055. But that's pretty close, right? We're not all that far away from that strike right now, only 150 points, so 3%. That is going to be very easy to make if there's a clean election and vol gets crushed and the market moves up at 3%. So I think 6,000 is very achievable. If I was going to project what I think happens is we pull back a little bit, and then that 6,000 level, is the target when we're down around 5,700-ish, right? So that means we need a little bit more of a substantial year-end rally to get into that zone. But for right now, you got to watch these upside strikes of 6,000 to 6,055 as kind of an upside target area. And the reason that we think that is achievable is because of this volatility crush that we see coming.
This next one gave me a little bit of nightmares though, because going back to my CFA exam here, you've got Black-Scholes on here, and option pricing was my biggest weakness on that exam. Like it made me so angry. It wasn't necessarily Black-Scholes, but it was this other one. I don't even know if it's used in the real world. This thing called the binomial option pricing model. I hated that thing. Like that thing was like. So you brought all that back up here with your Black-Scholes chart here.
There's a lot of different models that are used by people, and a lot of models have different strengths and weaknesses. But I just Googled Black-Scholes calculators. I just want to make this as simple as possible. So what I did here was I priced a reasonable kind of tail hedge, right? I just kind of plugged in an option, for example. So this is a 5,500 put that expires in about 4 months. So I just did a third of a year out, and what I wanted to show was, and I just use this as an example, right? And it's a little bit of an extreme example to kind of belabor the point. So the reason that I highlighted Delta here is because Delta tells us from a basic level how many shares of stock you need to hedge an options position, okay? So let's just say, for sake of argument, I bought this put, and the market maker is going to sell me that put, right? So Jack, let's say you're the market maker, you sell me this put. So Brent is long the put because he wants to hedge the election. Jack, you're short the put, and you say to yourself, I don't want to be short this put. I need to hedge this out. So what do? We're just going to say, for sake of argument, you sell 30 shares of stock, right? Because that's what the delta is. And just to belabor the point here, 30 shares of stock is what you're short against your put. Make sense? Yep. So that's with volatility at 30. And I just chose a near-term kind of high round number, depending on what option you choose and the expiration tenor, all that volatility changes. So again, we're just trying to make a very simple example. So vol is at 30. The day after the election, let's just say candidate X wins, whoever your candidate is, and everyone's like, great, candidate wins. What happens to volatility the next day? It sinks. Why? Because we have the clean election outcome. Everyone knows who the winner is, and we can move on with our lives. It works the same way when you have an FOMC or a CPI data print or any other event that the market's waiting on. If the event goes off without a hitch, there wasn't some tail outcome, vol immediately collapses. So all I did, the only difference between these two boxes is I switched vol from 15% to 15%. And that shifted the delta from 30 to 20. So Jack, you were short 30 shares of stock before against that short put. Just because the election went off, forget underlying stock movement, time passing, nothing else. All that happened there was the event came and volatility dropped. So now instead of owning or being short 30 shares of stock, you only need to be short 20 shares of stock. So how do you go from short 30 to short 20?
You're buying.
You buy 10 shares. So if you think about the hundreds of thousands of puts that are owned right now, and even VIX calls are in the same way, right? There's all these tail hedges on, millions of positions, right? Contracts. All of them are going to be repriced after the election, right? Vol is going to crush all of those put positions. And vol is going to come for sale, right? And that's the odds on outcome. And so you could see through this illustration, then when you extrapolate this from one single contract and 10 shares of stock having to get bought, suddenly you can say, okay, there's a lot of flow that could have to be generated, right? To the tune of possibly billions of dollars worth of flow. And that is the reason that we think that a clean election just knee-jerk responds by forcing the market higher into year-end as a result, just as an offset of the flows. And you can scream about so-and-so's various policies and things like that, but in the short term, I argue, talking about into the end of the year or the kind of into, November, end of November, this is the dynamic that is going to be most dominant in the market.
And this is great because we talked about the previous two elections where everybody was panicked and the market rallied. I mean, this is using numbers and showing exactly why the market rallied, because, dealers had to buy when the event went through and we didn't get the bad outcome or didn't get the worst case outcome. Dealers had to buy, and this is why the market went up.
Yeah, that's exactly right. And we have some more, complex models at spotgamma.com for people interested in this. But I wanted to just show the most basic example of why this matters. And we think about the VIX at 20, and we were talking about that premium, right? The spread between VIX and realized vol. That tells us how much vol can really collapse, right? So the VIX with a 10-point spread, right? If we go back to that chart here, oops, went too far. At a 10-point spread, if you're talking about where we are a month from now, we're probably at like a 3 to 2-point spread, right? And that's telling you that vol premium that's going to come out of the market, right? That's going to reprice those puts. It's going to reprice those VIX calls. Vol is going to be probably shorted, right? Implied volatility, and that's all fuel to push the market up.
So we're going to close here where we close a lot of the time here, which is NVIDIA.
Close where we started.
Again.
Yeah. And I do recommend people go check out that NVIDIA industrial complex. You can Google Spot Gamma, OPEX Effect, NVIDIA. The links will come up. NVIDIA over the last same period. So, I was admittedly sort of trying to agitate people to email you around the Trump polling thing. I don't know if that's the actual impact, but what I do know is an actual impact is NVIDIA. And you can see here right around the second or third, the stock really started to take off. The NVIDIA CEO has made some pretty amazing claims about the demand that's coming up and the like. And in regards of if that's the reason or not, the stock is up about 18% over the last month, and the S&P is up about 4% over the last month. And so if this stock continues to move higher, I think that the rest of the equity market is just going to continue to go up as well. And, the CEO is laying out this case to suggest that, even though it's at all-time highs now, that there's plenty of room to grow. And the thing that I think that is most interesting about this is that even though we've rallied 18% over the last, really most of those gains were made in the last 2 weeks, there are times where we see the call options complex is so bid up, and we've talked about this in previous episodes, right, where the call skew is so elevated that you go, look, these calls can never pay off. This is way overbought and due for a correction. We saw it in Chinese stocks recently, where call implied vol gets so elevated that you can buy a call and be right in that the stock goes up and you still lose money, right, because the calls are so expensive. Calls for NVIDIA are very cheap. This is January options skew. The shaded cone is 90-day skew. And the teal line is where we are right now. And what catches my eye here is we're at well under 90-day levels. And this is with the stock up 18% over the last, what is it, 2 weeks, which you think would generate a lot of demand. And so the people have not started to flood back into this theme in the options space. And as long-term investors, if you watch where call volumes just get excessive and implied volatility for those calls gets to be extremely high, that is a signal that the stock is overbought, right? That is a signal of excess returns, I will say. And so what is fascinating to me right here, and we've been talking about this theme for the last few weeks actually, is that, you look at NVIDIA, and if the market's going to go up, NVIDIA, I think, will lead the charge. And I think that these calls suggest that people have not yet begun really to pile into this idea. And so if we get a broad market rally, we're likely to see ultimately kind of this positive gamma complex come into, say, the S&P, and it's really going to kind of throttle how fast and far the S&P can go up. But we're likely to see the opposite for NVIDIA, where call buying demand forces market makers to actually buy the stock as it goes higher, whereas the S&P market makers may sell stock as the S&P goes higher. So this all ties back into the themes that had dominated this year earlier, right? Correlation and dispersion were these big factors a lot of people were talking about, because NVIDIA and the semis were going up, 2x versus the spiders. And I can't help to feel like these calls are very cheap and in a very nice way to play a year-end rally, because if we do rally, looking at semis or NVIDIA, I think those would lead the charge and could prove to really help lift this, to really be profitable to own these NVIDIA calls versus the index as a whole. And I would also say, as a partisan kind of trade, if Trump wins, we see long-term vol in Tesla be quite low as well. And Elon has obviously made it clear that he's siding with Trump there, and the vol in that stock is pretty low as well. So two very interesting ideas, I think, there into the end of the year. Obviously, the next time we talk, it's going to be November OPEX, so hopefully we know who the president is, and we'll see exactly how the market reacted to that.
Yeah, it'll be interesting to look like post-election and see what we thought might be happening relative to what did happen. Do we get the same pattern as the other elections, where we get that rally in the backside, or do we not? It'll be interesting to talk next month and see what happened.
Yeah, absolutely. And so hopefully this kind of laid out, the dynamics here, and I hope everything goes off without a hitch, and then we see vol get crushed in the market rally, so we can have some positive check boxes in our column.
Well, thank you everybody for joining us. Hopefully we can keep the hate mail coming to me at least to a minimum. But either way, we will see you next week, and maybe we'll start. Remember Jimmy Kimmel used to have like the mean tweets segment, like on his show. So maybe we'll have like mean emails to Jack segment that we could put on as part of the OPEX Effect going forward.
I support that. Yeah, that'll be fun. That'll be fun to do for sure.
All right, we'll see everybody next month.
Thanks so much, Jack.
This is Justin again. Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
The opinions expressed in this podcast do not necessarily reflect the opinions of Lydia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Lydia Capital.